Well, I'll get started. Hi, everyone. Thanks for joining us today. My name's Rachel Boyle. I'm the Executive Director at the New Zealand Chamber in Singapore. And with me today, I have Alan Henderson and Lisa Phillips. They're the co-founders of Erskine & Owen in New Zealand. Erskine & Owen are known for providing professional advice and expertise on property investments. So really, they're the perfect people for us to be talking to about property in New Zealand. Lisa and Alan gave us a similar talk around this time last year, and I'm really interested in hearing how things have changed in the New Zealand property market over the year, particularly following those New Zealand legislation changes recently targeting property investors. And of course, Lisa and Alan, we all want you to get out your crystal balls and tell us what's going to happen next.
Yeah, no pressure. Thanks, Rachel.
So, for attendees, if you've got any questions during the session, there's a Q&A button at the bottom of your screen. If you just type your question in here, and we'll save all the questions for that session at the end. But now I'll hand over to Alan and to Lisa.
Great, thanks, Rachel.
Thanks, Rachel. Hi, everybody. And the way we're going to run it this evening is Lisa leads our research side of the business. So she'll take you through most of the presentation. I'm going to talk a little, I'm a chartered accountant and authorised financial advisor, so I'll talk a little bit about the tax changes that have occurred and towards the end. But it's mainly going to be Lisa taking you through some of the impact, more about the impacts of the recent changes and where we think things are heading. So take it away, Lisa.
All right, thank you. Guys, I'm just going to share my screen with you just to get going, so just bear with me for a second. Okay.
Lisa, just if I could interrupt, you just might need to stop your sharing and go to the full screen mode. So come out of sharing and then go back into sharing and select the full screen mode.
Alan, does that look okay?
Yeah.
All right, okay. Sorry about that. Alrighty, so yeah, like Rachel said, we talked to you guys pretty much a year ago, and a heap has happened. Pretty much house prices have been skyrocketing since our first lockdown in April last year. Now New Zealand's house price growth in that last year is running at the second fastest in the world. We're only second to Turkey. And just to put a perspective around that, Australia is actually sitting at around 18. So in March this year, so the 23rd of March, the government attempted to curb some of this growth by doubling the bright line test on residential property, and then also another tax change, which is removing the interest deductibility for residential investment. Then they tried to bring a 3.8 billion spend into the budget with an attempt to boost supply and in an effort to make housing more affordable. I guess the question is this going to do the trick? We've also got thrown in the mix there is that Treasury have got a house price growth forecast at 17% to the year to June, this June, and then it's going to be, they're forecasting less than 1% for the following June 2022. So that's a pretty bold assumption in terms of taking the heat out of the market. Right now, the market is still in full swing, and we say that the market is kind of yet to agree on that. I'm going to take a quick look at sort of where we're currently at, what has happened over the last year, and then perhaps just have a look at some of the key indicators and considerations for the market going forward in the next little bit. Okay. All right, so how the big picture, how does COVID compare? I guess this is just a chance to, let's go back to have a look at what has sort of happened, how this sits within the sort of 20-year time frame. If you have a look at this graph just to get your bearings, this is graphing the house change in property value over a 20-year period starting back in 2000. So if you have a look at the lockdown period that was following April, right at the very right hand end, you can see that we're in some pretty unprecedented territory. Just to give you a little bit of perspective here, just if you could follow my mouse, 2015-16 we had quite a big boom to the market then, and we thought we were pretty crazy and frenetic, but of course that is not quite at the level that we've been experiencing in the last 12 months, and of course the last boom before that was in the mid 2000s. So pretty crazy activity. All right, so just a little chance to zone in on the last 12 months specifically. And if you have a look at this, we're charting this from May last year right through to May this year. So this is, you can see that growth has tracked positively month on month, roughly at around 2%. And we've sort of rounded out the year at about 24% price growth. So this is really significant and record levels. To put that 24% into some kind of context, the long-term average for New Zealand price growth over the last 20 to 30 years is 7%. So there is a little bit of a flattening off in the growth in April, so it's an early indication of that growth beginning to slow, but bearing in mind that any slowing of growth is coming from some pretty high levels. I guess it's fair to say that we would welcome any sort of recalibration around price growth. So 24% is pretty unsustainable, pretty unhealthy. We can't keep going at that level. So some kind of creating some kind of equilibrium here is definitely needed. All right, just to throw this in because I know that you guys do like to have a look at what's happening in the main centres and how they might compare to each other. So I just thought I'd throw that up. So this is the average dwelling value. Again, looking at it over a long period, but if you just sort of focus in on the right-hand end of the graph, which is our most recent activity in the last 12 months, you'll see that most of the areas have really been doing a fairly similar thing. And it's easy to talk about the sort of the national picture as a whole because most of the regions and the main centres have been behaving in pretty much the same way. If you have a look at the top of the screen, we've got Auckland and Tauranga. At the bottom of the screen, we have Hamilton and Dunedin in terms of the lower priced property. If you have a look, if you just follow my screen here to the sort of red orange line that's a little bit flattered, I guess that's the only sort of change that we've got from the trend. That's Christchurch. So all of the activity with Christchurch is following a slightly different sort of supply demand balance. There's a lot of activity going on in terms of construction, so demand, the supply levels are a lot greater compared to demand. So that's Christchurch, but everywhere else is pretty similar. All right, so just when we have rapid growth in house prices, investors naturally want to know, well, what's going on with rents? Rental growth is everywhere. So if you just have a look at this graph, I've thrown in a couple of regional areas, just not because I'm suggesting they're places to invest, but because just to show you that we have had rental growth across the country. Now, rents generally lag house prices by approximately 6 months and roughly keep pace with wage growth. We've recently, over the last 2 years, had a series of compliance changes with the Residential Tenancies Act. There's been a lot more cost put on landlords, and we're seeing a lot of that already passed on to tenants. So the upshot in terms of the average increase in the last year, this graph here shows us the 2020 annual rental growth. So that's January to December last year. Well, if you have a look at Auckland, for example, that's sort of tracking at about 6.5%. So the long-term average for Auckland would normally be about 4%, so we're well above average. In terms of the average rental price across the country, that sort of evens out at somewhere around sort of $30 per week. Just thrown in the gross yields here because people do like to understand what gross yields are. Obviously that is a national sort of picture, and then it takes into account all ranges of property types, so perhaps not super helpful in a specific sense, but it gives you an idea of what kind of yields that you can be getting with the current house price and rental pricing. All right, so that's kind of where we're at. And then I just thought we'd have a look at where we might be going, taking into account some of the fundamental drivers of the market. Now, for those of you who have been part of some of our property market updates previously, you'll know that we like to have a look at these things in relation to sort of demand and supply. Property market's pretty simple. It is all about demand and supply. It's just how those things are faring against each other that determines which way the market is going to go. All right, so let's kick it off and we'll have a look at the demand side. So we've got 5 key things there that we'll just take a quick squizzy at. And these are largely in, I guess, area of or priority in terms of how they might influence the market. So population growth is one of your biggest influences, then interest rates. We've got availability of credit in there, tightening of policy. So we've had a lot of policy changes in a relatively short space of time, and then we've got affordability. So we'll take a quick look at each of those. So with the population and net migration, I mean, this is pretty interesting in the sense that it's a massive change. Borders are closed. If you have a look at the numbers down the bottom, that's pretty much where we've landed for the March 2021 year. Previously, we were at 91,000 net migration. We're right down to 6.5. The graph there just shows you what's happening with New Zealand citizens, because this is where we have a massive change. So we've got more New Zealand citizens coming in. So in terms of the number of New Zealand citizens sitting in the net migration number, it's difficult to know how that would compare to the long-term average. What we do know is that we have a whole lot more New Zealand citizens coming in. I think it's important to note that when we're looking at the property market, that we do have that marked change in composition. I guess this is anecdotal, but suggests that a higher concentrate of cashed up buyers have come in with good equity levels, ready to buy given the circumstances that have brought them home. How will this change? Well, obviously that's the $1 million question. When will the borders open? That we don't know. But what we do know is that the net migration is a key driver of what the property market will do. The next key area is interest rates. So a lot going on here with interest rates. They are a key fundamental, direct correlation between interest rates and house prices. So the Reserve Bank has forecasted that the direction of the OCR is going to be up, probably as early as mid next year, so perhaps 12 months from now. And we think that now that this is starting to sort of circulate in the commentary, that investors will be looking to take this into account when it comes to borrowing. As you guys will be aware, the COVID environment is putting a lot of pressure on commodity prices. Like we've got labour shortages, we've got disrupts to the supply chain, and all those things are going to give way to some inflation. Now, should this be the case, we would expect to see that flow through to interest rates. Where we're at the moment is there's a little bit of creep going on the long-term rates. These short-term rates are still pretty fixed and low. Probably worth mentioning too, when we're talking about interest rates, that the New Zealand household debt is very, very high. So when we get small changes to interest rates, whether it be up or down, they do have a material impact on what investors will do. All right, so availability of credit. Again, this is sort of back on the table because we have had a recent change to the LVR again. If you just follow the little flow chart there, I just wanted to put that up because it gives you an idea that this is very cyclical in terms of these measures that they're put in place, they're taken out, they're put in place, they're taken out. And the first lot of LVR changes came in 2013, and we've had a raft of flip-flopping between then and now. The latest changes being that we have a 60% LVR, so that is the lowest that we've had for investors, and that covers the whole country. Previous LVR measures, some have just been in place for Auckland, so this is for the whole country, effective as of May. And then this is just showing you just where the LVR sit in relation to the house price index change. So again, that green line is the change in house price value. and looking at in relation to what happens at the time that we get changes to the LVR, whether the restrictions are put in place or removed. So it's very clear that LVRs, when they are put in place or removed, that they have a direct impact on market activity, whether it be long term. It's not certain, but they definitely do have a direct impact. We will see some immediate change. And I guess that's something that we might want to have a think about when we're looking at what the market might do in the next little bit, is that the changes that have come into place as of May, what is that impact likely to be? What would we expect to see? Would we expect to see some changes straight away, or would we expect to see some of that flow through over a period of months? The trending, if we look at history, would say that we would see some immediate response.
Lisa, can I just ask there, is there a case then that LVR changes have more of an impact on price than interest rates? Or sorry to start my video. So yeah, just to repeat that question, is there a case for saying that LVR changes or restrictions can have more of an impact on price than interest rates?
I think what they do have, and what it shows, is that they have a more immediate impact. What we know is that in recent years, interest rates have also had a big impact, just for the reasons that I said, is that we have a very high household debt consumption in New Zealand. So we're pretty much over double than what we were in the sort of 1980s. So again, we're in a place where even small interest rate changes will have an impact. What the LVR does is it shows to have a direct impact on the market, an immediate impact on the market. The interest rates don't seem to have the same immediacy.
Yeah, right.
But definitely the impact would be comparable.
Cool.
All right, so policy tightening, it's having a look at some of the latest changes. So going back to what I said initially, two changes, to, the one to the bright line test and the other to interest deductibility. I'm not going to get into the detail of that. I'm going to let Alan speak to those, but I just wanted to flag them here as something that we need to consider in terms of where the market might be headed in the next little bit. We think that investors are likely to sort of recoup some of the costs and losses that they might get through higher rents. We can see already that investors are not afraid to do that, and the market is able to withstand that. The rental market is able to withstand that. So I think we can expect to see the same thing going forward in response to these new tax changes. What we don't know yet is there's a little bit of detail around some of the areas, particularly around how the government plans to treat new builds. Once we sort of know that, then I think it'll be a little bit easier to perhaps understand and interpret some of what we see. To date, and I guess it is just early days, is it's no upward trend in sales. So what I mean by that is that we're not seeing a whole lot of investors liquidate and sell those properties. Again, it is early days, but nothing to indicate that at the moment. Alan will explain, but we've got there's sort of a 4-year phasing in of the changes in relation to the interest deductibility, and because of that sort of phasing in and it's incremental, we suggest that it will deter any fire sale type activity, which is it's positive. Okay, so we've got the last one there is affordability on the demand side. It's kind of an interesting area for me. When we're debating affordability, and this has long been a debated issue on New Zealand housing market for the last sort of 10, 15 years, there is this tendency to cherry pick the numbers, and it is a very political issue. So strictly speaking, when we measure affordability, we're looking at the house value to income multiple. And that has worsened in recent years. So for example, in Auckland, house prices are roughly 8 times the average income. But what we do need to do, particularly at the moment, is to look at the other half of the picture. And I feel that this is often missing from the commentary when we are debating affordability. So we've got household incomes, inflation and interest rates. Once they are factored into housing, it is a lot more affordable than it was a generation ago. Can you just hang with me here for a minute? That if we go back to the late 1980s, floating mortgage rates had increased to almost 20%, which meant that the cost of servicing a mortgage was roughly 50% of the median household income. And that was the highest level it had reached at that time. And then by the time we got into the early 2000s, the cost of servicing a mortgage on the median New Zealand house price had dropped right back to 34%. Now, at the moment, it is currently 37%. So despite the fact that the median house prices have increased dramatically since then, in inflation adjusted terms, the cost of owning a home right now is about as good as it's been since the sort of mid 70s. So I think there's a bit of perspective to be had around affordability. Yes, we've had a very steep climb in house price, but right now we're in the lowest interest rate environment that we have been for forever on record. So I think some of the balance in the debate has been lost, and I think we do need to just bear that in mind when we are reading about affordability, particularly the government is very it's very hot on it. It's very a very politically driven aspect of decision making for government as far as the housing market goes. Now, what I will say is that we aren't building the number of affordable houses in percentage terms as what we were if we went back to back sort of 20 years. So that is something that does need to be addressed. There's a number of factors to why that's happening, but just to flag that that I acknowledge that that is not happening to the degree that it probably should. All right, now I want to throw this in, demand, all the additional layers of demand, because some of them relate to COVID, not all of them, but these layers are really important to the property market. So while we have our sort of key fundamentals, we've all got these other dynamics that are sitting there. So we've got the expat layer, which is people who have expected a flood of Kiwis are going to come home, so they feel like they need to get into the property market. We've had people seeking more space to work at home. So the lockdown environment gave way to more people working from home, less time in the office. So then people have looked to wanting to buy properties that will serve that purpose. So again, bringing people into the market that wouldn't normally be there. We've got delayed travel, so people can't travel. So then they're turning to buy property. We've got FOMO. Now we've had this for a long time, particularly as the markets heat up, then people do have a fear of missing out. So it has a very sort of self-perpetuating effect. The parent layer, a lot of parents are becoming increasingly concerned that kids will miss out, and they are stepping in to help them buy. The last one in there is consumer confidence. Now, ASB run a housing survey quarterly. It's a really good read if you want to pick it up online. It is recorded that just under 70% of the respondents think that house prices will continue to go up in the next 12 months. And just to put some perspective around that, I think that's about the third highest reading on that survey in about 25 years. So there is an overwhelming number of people that think the market is going to continue to climb. That in itself cannot be ignored. All right, so let's jump over to the supply side. We've got building consents to look at construction, what's going on there, how many properties are on the market, so what listings are there, what is developer finance doing, availability of land. All right, so dwelling consents. Well, this is really good news because they're at record highs. So if you look at the very right-hand end of the screen, you can see that we've got about 40,000 consents going. We haven't been in this sort of territory since the mid-70s. The one thing that's going to dampen this is the construction side of things. So we have a building boom currently going on. With borders closed, we're currently dealing to some of the supply shortage, which is great. But the positivity from the consents issued most likely end up being netted off by the constraint of the construction sector. So right now there's just significant disrupts to supply of materials. We've got increased costs as a result of that, and we have labour challenges. So we had some labour challenges with construction before COVID and before the borders closed. Obviously that has now been exacerbated. With the record consents, we would not have the labour to get these consented dwellings built. So I think it's important to note that while we have got those consents there, the chance of getting them to an as-built phase currently is pretty limited. All right, so properties on the market. If you have a look at this, we have been trending downwards for a long time in terms of stock that's listed. And this is one of the reasons that New Zealand property market has survived a number of setbacks. And in particular, if we go back to the GFC in 2008, there was a huge amount of prediction that our market would fall into free fall. It didn't. And once we sort of stepped back and had a look and thought, okay, why did that not happen? What we saw was that the supply levels in New Zealand relative to other countries was very low. If you have a look at this, it is a trend and it is a structural issue. It is not something that is just part of the current cycle. And that is something that's quite important. We have a long-term issue with supply. So even though we have a little bit of increase in supply year on year currently, roughly about 5%, I think was our March figure on last year, it is not enough to reverse this trend. All right, so just a few things there on availability of land. So again, it's a structural issue. It's long-standing. We are making some progress while the borders are closed. The question remains is what happens once the borders are open. The approximate estimate in terms of shortage is about 70,000, and again, the estimate to clear that would be 5 to 7 years. So that's 5 to 7 years with the borders closed. That doesn't account for clearing it once the borders are open. We ended up with very limited housing solutions in the budget. So I think this has been quite disappointing. We had a budget announced about a month ago. So this has been a little bit disappointing. There was a few things in there, but nothing of substance. And of course, as we've just said, the capacity of the construction sector to deliver on this is obviously going to affect there's no point having the availability of land if we can't get get houses built. We really do need a long-term solution to that. What is that long-term solution? In our view, it really comes down to two things. We need to deal with the Resource Management Act, which is a piece of legislation that's 20 odd years old, and a lot has happened in that time, both with the environmental side of things and also with population growth and land and the requirements of infrastructure. The other side that we can address is immigration. Of course, this is a much more difficult area to look at and probably a little more limited in what can be done. All right, so just a few comments in terms of sort of wrapping up what we think the supply and demand balance might round out at. I think that it's fair to say that both are likely to diminish in the coming quarters. The underlying fundamentals suggest that prices will continue to rise at perhaps a slower rate. What is unclear at the moment is what that rate will be. There's still a number of things out there that are uncertain. Obviously, rolling out our COVID recovery plan is still very much up in the air. When will the borders open? What will happen in terms of construction, and when will that become mobilized again? And of course, that's reliant on what happens globally. So a number of things that's still very difficult to speak to. The changes with the tax changes in terms of new build in particular, what will that look like? What will be the rules around that? But I think that there's enough there to suggest that we will continue to see some upward pressure on pricing. Supply has got to be the leading factor in that. All right, so we're going to make some progress in 2021, but long-term slowing down with construction. We need some structural change on supply side, so we've already talked about that. Investors, particularly residential investors, are going to need a longer time period for realising capital growth. So this goes back to the Bright Line test, where it's increased from 5 years to 10 years. But property, in our view, is still a viable investment class. We have a number of clients that we're working for at the moment. When the March 23 tax changes came in, we asked those clients to just pause and go and just make sure that they were okay with those changes, get some advice if they needed to, and come back to us. All of those clients that we're currently working for did come back and continue to pursue their investment plans. The question is, just in general terms, and I'm not trying to advise anybody on a personal basis, is that if you don't invest in property, what do you invest on them? On the assumption that you are pursuing a balanced portfolio, there's still a lot of really good opportunity in residential property. Just throwing up a couple of things here which came up in our Hong Kong seminar, which I just sort of wanted to flag if that you are thinking about buying in the near future, what you might just want to take into consideration. So the apartment market is pretty slow right now, with the student market not being able to come into the country, and then the tourism market is impacted with the Airbnb rental. So if you are looking at either of those, we recommend that you sort of tread with care. Supply chain considerations. So again, going back to all the factors around construction, is if you are looking at something that might require a do-up, might require renovation or any kind of remedial work, there will be some difficulty in getting those things done, whether it be cost, whether it be timeline, or whether it be getting the labour to do it. And what these things can invariably end up in is that you have a longer term vacancy. So if you are looking at something that is going to require the construction market or tradespeople, materials, bear that in mind. All right, so opportunities outside main centres. I know that everyone's sort of interested in where might be good places to buy in New Zealand. What we have seen in recent time, and this is not just limited to COVID, is that the regions have started to flourish. We've seen a lot more activity and industry move into the region. So there is a lot of good opportunity outside the main centres. What you do need to have a look at, and particularly in the post-COVID environment, is what is the local economy doing? Does it have a good standalone economy? Have a look at it. Is it growing? What are its main industries? Are the industries that it's mostly known for? Are they industries that are going to be resilient in a post-COVID world? And what is the growth story? Are those areas growing in terms of population? All right, and the last thing to just throw in there is commercial property and syndication as alternatives to residential property. The reason I pop that in is the latest tax changes relate to residential property. They don't apply to commercial property and syndication. So that's something to perhaps have a look at. Don't have a whole lot of time to jump into what the commercial market is doing. The commercial market is definitely alive and well, and we've seen a lot of yields be compressed over the last sort of 12 to 18 months. The retail sector has struggled understandably, but has come back in the larger settings is doing well. Prime areas in terms of office are back doing well, and the industrial sector has continued to perform well throughout the COVID period. So just a quick sort of nutshell on that. Alan, do you want to add some more comments around commercial property and perhaps what's going on with syndication?
Yeah, I mean, I'd probably be a bit more bullish about commercial property. It's going nuts. Anything that's got a good tenant with a reasonable lease term in a good area or a strong city, major city, it's been really strong demand. So we're seeing a couple of recent sales in the 3% range, which wouldn't be unusual for Asia or Hong Kong or Singapore, but in New Zealand, it was not that long ago that you could walk down the main street of Hamilton and everything was 8%. In those days, they're well and truly gone. for us to be competitive when we're buying syndication property, we're in Hamilton or Auckland, we've got to be sub 5%, and in Auckland, in Hamilton, and maybe sub 5%, 4% in Auckland. So the landscape is changing really rapidly, and people are after quality, and we've definitely seen that. So what's happening is that for the people that are perhaps deciding where to invest in property with the changes in residential, they're now saying, well, let's look at commercial, and if they're not prepared to invest directly, then they're looking at investing through syndication. So the life cycle of our business has been, we started out just helping people invest in property. So we act as a buyer agent, started out that way, still do. Then we moved to property management. But as portfolios have grown and we've built and bought the residential properties that people have targeted, and we've helped them set those goals, they've then said, well, what's the next step? And commercial property is a natural, I guess, transition or next step. And some go to the direct route, but for others, good quality property, you really don't want to be spending less than $2 million in the commercial space. So syndication becomes an opportunity. And for the offerings that we put out there, there's never any lack of people to talk to about it. There's a lot of money around looking for a home. The current one that we've got out there at the moment, which is three industrial properties, that's getting really strong interest. So yeah, we've definitely seen industrial property, and partly that it's not just the lack of attraction or some people not being as enamored with residential. It's also because deposit rates with the bank are nowhere near what they used to be, and so people really need to get their money out of the bank and into another option to earn the retirement income that they need. So that and obviously I probably, by saying that, I am talking about a lot of retiree money. So yeah, commercial is very, very strong, particularly industrial. Pre-COVID industrial, big box retail was really strong. It's still reasonably strong. Office, I don't think it's dead. It's going to change. Work from home is obviously something that's opened right up. But excuse me, but I don't think office is dead. It's just going to change. The nature of it will change. Back to you, Lisa.
All right, thank you. I just wanted to circle back to the two lots of tax changes that came in on the 23rd of March. I'm sure you guys like to know a little bit more about that. Like I said, the impacts on that is sort of probably fairly early days to comment any further. But Alan, are you able just to perhaps précis what those changes are about? That's more your domain, to lots of the interest deductibility and the extension to the Bright Line test.
Yeah, so 27th of March is a key date when, so anything purchased from that date will no longer, any existing property that's purchased from that date, you'll no longer be able to deduct interest, full stop. So that's the first thing. Any existing property that you purchase from now on, you won't be able to deduct interest. The property that we already own, that you already own, you can still continue to deduct the interest, but it gets phased out over a period of years. So over the next 4 years. And if you want some more detail on that, we can provide a paper that we've written on it and exactly how those dates and how it transitions from 100% down to 0% over the next 4 years. They've indicated that new build properties, you will be able to continue deducting interest. And we're assuming that will happen, but it's not set in stone. The legislation hasn't been finalised. And so I guess one of the key things, it's probably unlikely that they wouldn't allow deductibility of interest because they've signalled that. But the question will be, what is the definition of new build? And that's pretty important. So we do know that they've been quite explicit that renovations are not considered new build. So any renovations that you do to existing properties, investment properties, you won't be able to deduct the interest on that. It just to kind of take a step back from it, when we came in, it came in without any warning. Usually you get a whisper of these things happening, but they acted pretty quickly. And so we were pretty shocked and thought, gosh, will that just turn off the tap for us? And will that mean the death of our buyer agency model? But you know, that was in the morning. By the afternoon, we started running numbers and figured out that actually, if you think about it, it's probably very roughly equivalent to interest rates going up at 1%. And that's making some assumptions around the loan you might have out on a property. So it might be a 600K loan on $1 million property, and make some assumptions around that. It's probably less than that, because now that we've got this non-deductibility of the interest, we're going to start looking at everything else that we can deduct, and any expense that we can claim, and how we can split. You know, do we go back to using a look-through company and splitting up the loss, the profits, I should say, and then, you know, targeting lower tax rates, but that's up for the tax experts. So, and I think a lot of people have done that, and most of our investors, as we talked with them, decided that that was probably the way that it was going to head for them. And so that's probably why we haven't seen a drop off in any of our clients, because they've said, well, it's really just an additional cost. And I'd also go back to, you know, we've been doing this for, Scott and I, we started almost 15 years ago, and it was really like the national government rolled out the deductibility of depreciation as a tax expense, and there was quite a furore around it at the time. And I remember holding, you know, when that happened on our own portfolio, it was, gosh, you know, what's the cash flow impact going to be? But now it's forgotten, and we don't even remember it. It's just out of mind. And I think, look, interest is a bigger line item for a lot of people, so it will have an impact, but I don't think it's the end of the world in this interest rate environment. That's the interest deductibility. I'm not happy about it. I'm sure most people aren't, but what it does mean is that I just don't think it's a game breaker for most. And the last thing I'd say on that is, of course, at the end of the day, is the capital gain that you're assuming you're going to experience going to outweigh the disadvantage of the non-deductibility of interest? And I think for us, the answer, well, you can decide for yourselves from what Lisa has said, is probably yes. Just moving through it pretty quick. So Bright Line has been extended. So there's a little bit of when is a property deal is an unconditional date or at settlement, and you really need to err on the side of caution and do it when there's a binding agreement. And so I'll get tax advice on that if you're not sure. If you've got a transaction that's straddling that 27th, where you perhaps contracted on a property pre-27th, just get some advice on that. So now it has been extended for properties purchased after the 27th of March to 10 years. And yeah, so if you sell a property within 10 years, then you're subject to tax on the capital gain, and that's definitely something to be aware of. And then finally, the LVR restrictions. So they've cranked those back up again, and the Reserve Bank has brought those in, and so there's a limit to what the banks can lend you. So they have a percentage of borrowing that they can do above 60%. But I think regardless of that, the banks have been pretty careful about who they lend to. So even in a environment where you can leverage right up to 90% on investment property, it's not like the pre-GFC days, from what I can tell. We've got an in-house mortgage broker, Wendy, and so we're talking to banks all the time. And our view is that the banks are pretty cautious about who they're lending to because of the environment that we're in. So even though in some instances they may be able to lend to you, you may meet the LVR, you might have the capital, they may restrict what they lend to you based on serviceability criteria. And the way they do that is they just crank up the interest rate hurdle rate, so that they might assess you on a really high interest rate. The RBNZ is who sets the LVR restrictions and enforces that with the banks. It's the Reserve Bank of New Zealand, but it's not the only factor in there. Having said that, as soon as the LVR restrictions were lifted, as you can see from Lisa's graphs, everybody went out and had a party and bought up large, and that's brought it back My view is that LVR restrictions are they're never going to be forever, because they can't be, because what happens eventually is that you will stymie demand, and it will bring demand right back, and it will in a very blunt way solve the rising house price issue, but it doesn't solve it forever, because eventually you have this unexpressed demand in the form of a growing population. So, eventually we'll come out of COVID, the population grows, they need housing, and for developers to develop housing and sell it, they've got to have people that can buy it. And for people to be able to buy it, they've got to have access to capital. So I don't see it as a long-term thing. And we know that eventually they'll have to, I guess, ease that to allow people to be able to buy. So ask questions, and for sure, if that's if you got anything on that. Back to you, Lisa.
All right, Rachel, I think that's sort of probably enough to sort of hopefully give people a little bit of an overview of where we've been, and perhaps some of the things that we need to take into consideration going forward. If there's some questions there or some areas that people would like us to recircle back to, then let us know.
Yeah, well, thanks, guys. That's certainly a lot of food for thought. From this side, there's a lot of factors at play at the moment, aren't there? And now this is your chance, attendees, if anyone wants to ask any questions. I had a question around the supply side, which is what do you think would be the one thing that would make a huge difference to an improvement in supply of housing in New Zealand?
My personal view is that we do need to repeal the Resource Management Act. That is the big thing that is holding back that making land available for development. Right now, there is just so much red tape and bureaucracy around taking land and getting it from, a piece of land to getting it built is just an enormous exercise right now, and we've got all the environmental constraints in there. What's happened in the last 20 years is we've had all these changes to the environment. What's happening with the use of water across our land? We've got all the climate change. So all these things are becoming more pertinent, but yet we've got a fairly outdated piece of legislation. Now, to be fair, it was only 1990. So in terms of sort of the age of legislation, it's not that old, but it's definitely very outdated, and we need to urgently repeal it. It's a massive undertaking. I don't think any government wants to take it on. I think the current government knows it needs to be done. I think that they're just hoping they can get through without doing it.
Make it go away.
yeah, but unfortunately it's not going to go away, and I think this is the thing that we need to get very clear on, is this is a structural issue to New Zealand. It is not a cyclical issue. It is not interest rates and some of these other measures that the banks are bringing in that we will cycle in and out of. This is here to stay until it is dealt with once and for all in a fairly substantial and sustainable way.
Right, and then we've got another question here around investing in Queenstown. So can you share your thoughts on the investment landscape and what's happening in Queenstown?
Assuming that you're talking about residential investment, what's been really interesting about Queenstown in the last 12 months, given that the tourism there is obviously being decimated, and also rents dropped between about 15 and 20% initially. They're starting to climb back now. In spite of all that, the housing market and house prices continued to climb, and we've seen upward pressure on that pretty much since lockdown last year, which has been quite incredible. What's driven that? I think it's that whole mentality that people are seeing beyond COVID. They know that one day things are going to come right, and I think the COVID environment, and particularly what they're seeing globally, is a lot of people are going, hey, New Zealand's a great place to be. Queenstown, of course, is the jewel in that crown, and hey, I want a piece of that. I think there's still a huge amount of not just New Zealanders, but people who have ability to buy in New Zealand that go, hey, I want a piece of that. So look, even I love the Queenstown market, and I have do a lot of work personally in that market. It's definitely been quite surprising given what's happened with tourism.
Right.
I see there was a chat there on commercial property. Somebody saying, do you have any further information you could share, maybe just type in what specifically you'd like to know about commercial property, because if I've got a couple of minutes, happy to share some more on that. And but maybe some of the areas that we've seen grow similar to residential is that with the flow of population, people looking to live not just in Auckland but outside of Auckland because of the cost of Auckland, that's then growing demand for commercial property as well. So previously we wouldn't have ventured much further than Auckland or Hamilton for commercial property, but now with population growth in those areas and residential growth, it in part justifies going to different areas. So in fact, we've purchased 4 or 5 properties in the Hawke's Bay over the last few years. We'd purchased in Christchurch, and we'd happily purchase in Dunedin and Queenstown. Wellington might be a bit trickier, but we'd definitely look at it. So I think commercials followed a similar track in that the latest boom has really opened up different parts of New Zealand.
I think what commercial has, what's thrown the spotlight on commercial, particularly post-COVID, is the tenants, that we would need to really look at what kind of tenant you have in the property that you're looking at. Is it a tenant that is going to be fairly resilient in terms of COVID, and particularly the uncertainty in the global environment going forward for the foreseeable future? What is their industry? And we're seeing that too with the way banks are approaching the funding of commercial property, as it comes a lot more weighting is going, particularly around value as well, to what kind of tenant it is, what is the strength of the tenant. Previously, we haven't needed to look at tenants in quite the same way as we need to look at them now. So that's been a pretty interesting journey in the last 12 months around tenants.
Yeah. We've got another question here around, you had a chart that showed that Christchurch was not experiencing the same kind of levels of residential property growth as other main centres. And why is that? Is that because there was a boom post the earthquake?
Yeah, so the earthquake's really sort of pretty much threw the whole sort of supply demand landscape there into disarray. It's starting to change now. The supply levels are becoming a little bit more constrained, but what is there is a huge sort of pent up sort of level of supply post earthquake. So it's really just an overhang of the the earthquake environment. I don't expect it to stay that way. It'll eventually trade itself out of that. And now that we're moving into an environment where construction is constrained, any further construction, bearing in mind that we had a huge amount of resource thrown at Christchurch, that's going to become in short supply. So we're not likely to see the supply levels in Christchurch increase anytime soon. So I think we'll get a catch up there. And if you go back to that graph, there is a little bit of an uptick right at the end. So we're starting to see that change. It is becoming more constrained on the supply front. But yes, for the last sort of 2, 3, 4 years, it's been pretty flat relative to other centres.
Right, and then a final question from me around apartments. So you mentioned that you wouldn't recommend them as much as for an investment property buy, and that's students not coming in and that kind of thing. Can you see a time when New Zealanders will see living in apartments as a viable option? I'm thinking a lot of us over here live in apartments, with families, and it is something that's quite normal. Can you see that happening in New Zealand in the near future?
Well, I think we do have a move to that already. There is an adjustment to Kiwis around the types of property they need to live in. Affordability has been one driver of that, and I think we will continue to see that track back to where we have been. What we've got at the moment is that a lot of, particularly the inner city apartments, there isn't the student market there. So it's really where apartments are fed by student markets that we really need to watch carefully. If we're looking at sort of low-rise apartments out in the urban areas, then that might be a different proposition. what we are seeing, particularly as we get a lot more new build, and we do have a lot of building going on at the moment, is that just got to look at the quality of that and really do your homework on the quality of the building, so that you're not left carrying the can on some, you know, sort of poor building or systemic issues later on, and get caught up in a body corporate where you're sort of hamstrung and got costs that you that would be, you know, unforeseen. So all that sort of thing really does come back to the quality. Right now though, is that the market has on like city apartments right now, you can get a really, really good deal on a city apartment. I mean, you can get a little 2-bedroom apartment in Auckland City for, you know, at leasehold apartments are like running at around 50k at the moment. Now that's really attractive to some people, and they want to sort of run and go, hey, wow, I can have an inner city apartment for, you know, 2-beddy for 50k. Now admittedly it's leasehold, but when you look behind these things, is that you know, that's just going to be quite unsustainable right now in terms of renting it. It's different if you want to live in it, but from an investment point of view, look, I think there's just a number of things there that need to sort of be shored up before that's going to be a really reliable investment.
Yeah. We've also got a question here around, has there been a change in the popularity of certain types of residential property? So, for example, have people moved from looking at, say, 3-bedroom houses to 4-bedroom houses recently?
Not so much. Interestingly enough, we haven't seen the change in terms of the buying and selling market. I mean, the market's just been crazy regardless, and people are buying, you know, do-ups and paying, you know, top dollar for something that you wouldn't put your dog and cat in. So no change there. What we have seen over a period of time is changes to where the demand is compositionally in the rental market. So as things have got more unaffordable, we've seen more demand in the sort of 5-6 bedroom type homes, and then more demand in 2 bedrooms, and probably the sort of the weaker area has been in 3 bedrooms. Now that doesn't reflect to the buying and selling, but it does reflect that people are needing to move into housing types that are more affordable. So obviously 5-6 bedrooms, they're obviously merging families. 2 bedrooms is where perhaps they would otherwise have been in a 3-bedroom, and they need to downsize because they can't afford to stay in a 3-beddy. So yes, rental market, yes. Buying and selling, no.
Right. Interesting. Well, we've come to the end of the questions, so and we're nearly at our time, so I think we'll wrap it up there for today. But I just wanted to say, on behalf of the New Zealand Chamber and everyone who's attending, thank you so much, Lisa and Alan, for your expertise and your insights today. And what we'll do is we'll record this webinar and we'll send it out to those who weren't able to attend today, but also we'll share details if people want to get in touch with you and ask further questions about the New Zealand property market.
That's great. Thanks, Rachel. Thanks everybody for joining us.
Thanks, Rachel. Okay. Good night.
See ya.
See ya.